Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. I know times aren't looking great right now, and if you think you may need money for your mortgage or to live on and have to sell some shares in order to do so, then it's understandable. Holding Tesla shares is not worth becoming homeless for. I don't know, did any of you sell up absolutely everything, so much so that you're now homeless? Let us know in the comments below, because that's some serious conviction. Anyway, how about we look at a forward PE for Tesla, whilst the stock price is available on sale today at these low prices. However, instead of a forward PE being some arbitrary time period like 1 year, let's pick a future time more relevant to Tesla, something close to a year still, but also a time where they've wrapped up some of the projects that they're working on now. I would guess something close to the end of next year. So instead of a 1 year future PE, I'm going to use a future which is probably closer to 18 months. In order for it to just be a more suitable time for Tesla's valuation. We have a difficult time ahead of us to navigate through the business, both internally and in the macros. A regular forward PE would include this nightmare Q2 and a potentially not so hot Q3 as well, which will end up skewing the numbers to not give an accurate and fairly portrayal of the true value. Similar to when Tesla was crashing last year and dipping even below $600, we would do our valuation estimates, and it just looked like it was too good a value not to buy. Look, let's face it, I've never admitted I can see the future and know what's going to happen. We have no idea what will happen with inflation, the economy, or rates. We don't know what the value of a dollar will be in the future. But as for investing and wanting to put your money somewhere, then to me, I can't think of anywhere better than Tesla, although I am keeping some cash on the side at the moment too, as a buffer in case things get bad. But my point is, what if you converted everything to cash? Do you think that's safe now either? My investment and advice that I preach is more about trying to buy low and hold in a safe way. But I do use 10% of my portfolio for more risky trading. And although it's only 10%, I am a lot more active with that, obviously, and can thus regularly share my latest trades and strategies. Now, in this future scenario, we aren't going to say everything went perfect either. The scenario we're going to play is Fremont has ramped up to perhaps 10 to 20% more than it is today. Shanghai's new fab was built, and the total of Tesla China is at a run rate of 2 million a year, which is the rate at which we can expect according to what Tesla were telling Reuters. However, we are going to say that the 4680 ramp is still taking a little longer than we hoped, but the factories are nearing volume production and each operating at break even. In other words, to keep this simpler, I'm just going to delete the new factories, but I'll be adding in the extra fab in Shanghai. So for the record, this is not me saying this is what I think will happen. I'm just trying to use a more balanced approach. For example, it might be at the end of the year that China is suffering economic and maybe political issues, and things aren't going so well there. And on the other hand, maybe Texas might be at 1 million a year. I hope that's not the case, but that's why I want to balance it out. And to be honest, I hope this is a bear case more than anything. But either way, another angle on how we can value Tesla, particularly at times like this when it becomes more difficult to gain perspective. At the same time, we know we should buy when others are fearful. The question is, just how fearful can they get? And it's a serious question, as the market can go far beyond rationality. You'd be amazed. Hence, why no one can ever predict what it's about to do. If you ever think you get it, then you're in trouble. Alright, so I'm not going to do this PE ratio for the entire year, but solely related to a single quarter that has reached these events. So no, this isn't literally a forward PE, but as Tesla is still in such a growth stage, I feel like this is really a much more apt way of giving Tesla a forward PE, especially if you were to compare it with a forward PE of a legacy company, given they likely won't be at 2 to 3 times growth at this stage. And this scenario is mainly seeing the growth in Shanghai, and this would be due to CATL's growth with LFP batteries, which I think would be fairly straightforward, at least relative to a lot of other things that go on in the Tesla world, such as the revolutionary new 4680 cell, which we are discounting in this model. And as I've said in the past, once that gets going, then the stock price should triple. So before that happens, what's the PE ratio of the future of the rest of the expansion at today's stock price? We'll give Fremont a run rate of 600,000, so 150,000 for the quarter, which is an increase of 15% from Q1. And we said Shanghai would get to 2 million, or 500,000 per quarter, and we're deleting the other two, as they are cancelling their costs out with enough profit, just to keep it easier. That's 650,000 deliveries, an increase of 110% from Q1. Does that sound likely? Well, that's actually about 60% growth year over year, which is pretty realistic. Remember, we are comparing the first quarter of 1 year to the last quarter of another. It is nearly 2 years difference. Of course, we do have the other factories too, which we're saying would be at around 80,000 total for the quarter. But including those factories, it still fits within 60 to 70% growth. which is kind of what Elon has suggested. We can go through these numbers quickly, as you've seen many times how I work all this out. And through experience, we know that my estimates tend to usually be close to within about 1% of the real numbers, so it's a fairly well-tested model. When I enter all the numbers in, we get to $34 billion of revenue, along with a little bit of FSD revenue too. I'm going to go with just a 32% profit margin, as we really are only focusing on Shanghai and Fremont, and we don't have those new 4680 structural pack cost savings yet. However, the new factory in China might have, and should at least have some improved margins. Like I always say of these models, we don't need to really worry about the other sides of the business for now. Even if the revenue is up, energy is likely to still only be about break even, and any profits would be dwarfed by auto profits anyway. I've also increased R&D and SG&A, although these could be higher due to Berlin and Austin, but remember, we are cancelling them out, as they are in a break-even state. Anyway, once we get down to it, we're at $7.8 billion in profit, compared to $3.3 billion in Q1, and 140% increase in profit, yet only about 110% increase in deliveries. More evidence of more economies of scale kicking in. As I say, when we get to about 3 million deliveries, then we're really into the economies of scale. From there, the extra economies from the additional scale do start to diminish. Alright, well that's a fairly decent improvement in profit, but let's not forget the reason we did this. We wanted to work out our own special Tesla forward PE ratio. Alright, well let's get all the numbers. An $8.1 billion quarter would be $32 billion annualized. At the time of this video, Tesla is sporting a $790 billion market cap. If we relate that to this scenario, then we're at a forward PE ratio of 25. Granted, that forward PE ratio has been somewhat manipulated of its definition, but to me, this is still useful information, especially in times like this, where I'm trying to place some sort of intrinsic value on Tesla in case the crash gets worse. Alright, there we go. I've created a customized forward PE that I feel gives us a better idea of the future valuation, more tailored to what is happening with inside Tesla. Of course, you can say I arbitrarily cherry-picked these dates to make Tesla look like it's more valuable. Well, either way, so what? It doesn't make the valuation any less true. We're still within 60 to 70% annual growth rate here. Remember though, this is hopefully a very pessimistic Berlin and Texas. Chances are they should be doing double that by then. But China still has so much easy growth remaining and can pull the company for a bit longer. But those new factories really need to start pulling their weight sometime next year. I estimate we could be at this level at around the end of 2023, but in reality, even if it's not until mid-2024, it's still an exceptional rate of growth, especially from a company already this size. But we get to enjoy this level of growth still, because although the company valuation is large, the actual quantity of sales is still relatively low. It's just that Tesla make so much profit for every unit they sell. Well, when the sales numbers start to approach some of the legacy numbers, Tesla's total profits are going to break records. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.